Well, good afternoon or good morning, wherever you are now. It's a great pleasure kind of moderating this discussion with my dear friend Brent Johnson. We've met in person a couple of times. It's always a great pleasure to meet you. With Louis and Gav, we haven't met in person so far, but I love just your writing, your books. It's just super thought-provoking. I just really, I'm a big fan of yours. And then also Niko Jilch, my dear old friend, who will be co-hosting this with me today.
Good afternoon.
Gentlemen, thank you very much for taking the time. So today is April the 30th. So today is Big May Day in socialist Austria and the rest of Europe. Nobody's going to work, but we're working full steam on the upcoming In Gold We Trust report. So this will be a part of the In Gold We Trust report published on May 17th. And I would like to briefly introduce our special guests today. First of all, Louis and Gav. He's the CEO of GavCall, a Hong Kong-based company he co-founded over 20 years ago with his father Charles and Anatol Kaletsky. GavCall has grown to become one of the world's leading independent research providers to institutional investors around the globe. Louis has written 7 books, the latest being Avoiding the Punch, but also, as mentioned, The Clash of Empires, Currencies and Power in a Multipolar World. Louis, thank you very much for taking the time. It's a great pleasure.
It's my pleasure. Thanks a lot for having me. I'm glad we can meet up and always happy to catch up with Brent and Niko.
And then there's obviously Mr. Milkshake, Brent Johnson. Brent, you're bringing 25 years of experience in financial markets, and now you're the CEO of Santiago Capital. You've got a pretty long career in finance, having been managing director at Baker Avenue, a $2 billion asset manager and wealth management firm. Before that, you worked at Credit Suisse in their private client group. And as we all know, he's quite vocal on Twitter. He's as I've said, Mr. Milkshake, and every time the dollar drops just a little bit, people for some reason have to kind of ridicule Brent. But I think, if you know Brent, then you will know that he has got a very balanced view that the dollar is just one part of the story, but that actually he's I would say in the best way, a conservative asset manager with really great macro thoughts. The both of you are great thinkers, but you're also fun. I know you both are very much into sports, although, Brent, the last time we met in Vancouver, I was really nervous because in the beautiful game of handball, Germany was playing against Austria, and you said, "What is handball?" So
I didn't even know handball existed.
So Louis, you're mostly into rugby, I think, but you probably know handball. I think the French are also pretty good in handball. But what I just really love,
we have more World Cup than any other. We have more World Cup than any other country. 6 World Cups.
But making good sports analogies when it comes to the very complex world of global macro, I think that's really the best way to make the case for your thoughts and to really explain those complex thoughts. And then there's obviously Niko Jilch. Niko, thank you very much for taking the time as well.
Thank you for having me.
Niko has been writing the de-dollarization chapter in our In Gold We Trust report for many years. Now he's a super celebrity in the Bitcoin world. Niko, what shall I add?
Nothing. I think super celebrity sums it up pretty well. And no, I'm glad to be talking to you three heavyweights today, and I'm looking forward to a discussion on China, the US, the renminbi, yuan, the dollar, and gold. That's what I'm here for.
Excellent. So, yeah, we'll jump right in, I would say. It's going to be a casual discussion about, the topics of dollarization, de-dollarization, global macro, what's going on with the Japanese yen at the moment, what's going on in the world of gold, Bitcoin, obviously. I mean, I think we are all pretty excited about, all those different macro developments going on at the time. And we all try to solve this kind of 3D puzzle, and sometimes we succeed. But let's just jump into the big discussion. As I've said, Louis is really well known for his great analogies, and a while ago you basically compared the US dollar system to operating systems. So you said that the US dollar is quite similar to Microsoft Windows, and even though Windows crashes from time to time and it has flaws and people don't really like it, it's still it still has some sort of the monopoly when it comes to operating systems. Of course, there's Apple, there's Linux, and so on, but at the end of the day, it's just sort of a monopoly. And probably a currency is a classic network good, like law is, like language is. I mean, there's a reason why we're talking now in English and not in German or in Mandarin. Gold is probably also some sort of a network good. And the big major question over the next couple of minutes will basically be if the dollar will be replaced over the next couple of years. So let's just jump in with a very general question. Louis, what would you say? Will Microsoft Windows and or the US dollar still be the central player in, let's say, 10 years from now? What's your view?
So first, let me start off by saying the reason we're speaking English is that it's the easiest language to speak badly. And relative to any other language, and so by default, yes, it's become the lingua franca of the world. Now, will the U.S. dollar still be the dominant currency over the next 10 years? Yeah, like I said in my books, and I've made this analogy for the past 20 years. The U.S. dollar is the Microsoft of the world. And you can chip away at it, but to replace it, you need not only to come up with a system that's, better. It needs to be much better so that everybody changes it at once. Now, having said that, the story of the past 20 or 30 years, while Microsoft was still dominating and doing a great job, you actually did better with Apple. Right? I mean, if you bought Microsoft in 2000, it was a 500 billion market cap, and of course, it's more than 2 trillion today. But Apple was a 50 billion market cap, and it's also over 2 trillion today. And so, what you saw in relative terms in the past 20 years is basically Apple created a new operating system, right? They invented the smartphone. Well, first the tablet, then the smartphone. And from there, a lot of people moved to a new operating system, which was Apple's operating system, and sometimes run both side by side. This is, in my view, what the renminbi is trying to do. The renminbi has basically said, look, the growth in the world for the next 20 years, China said the growth in the world over the next 20 years is going to be in trade in emerging markets. That's where the trade is going to happen. Now, trade between Mexico and the U.S., that's always going to be priced in U.S. dollars. But there's no reason trade between Mexico and China needs to be priced in U.S. dollars. There's no reason trade between South Africa and Zambia needs to be priced in US dollars. So we're going to attempt to create a new operating system there. And lo and behold, this is happening. We now live in a world where 20% of oil is no longer priced in US dollars. Now, again, like 10 years ago, this would have seemed madness, just like it would have seemed madness that Apple could be on 30% of operating screens today around the world. Like 20 years ago, that would have seemed stupid. So you can sort of chip away at it through specialized trade. And the reality again is that most of the growth in trade today is emerging markets to emerging market. In fact, that's the only growth in trade in the world now, is emerging market to emerging market. And that trade for a number of reasons, whether it be geopolitical, such as the Russia sanctions, whether it be financial, such as China offering great financing terms to Africa, to Southeast Asia. For a number of reasons, that trade is moving along. So it is a changing world. And I think the Apple analogy to Microsoft works decently well.
Brent, do you want to jump in?
Yeah, sure. So I actually like that analogy. It's a pretty good analogy. And I would make a couple observations about it because I think it does make sense. The first thing I'd say is that the world is very clearly going through a divorce, in my opinion, right? And so when you go through a divorce, I've never been through one and hope to God I never am. But when you go through a divorce, some things happen because they have to, right? Another house needs to be purchased. New insurance needs to be bought. Powers of attorneys need to be changed. And so when you have that happen, then things are going to change in the world. So I would not sit here and say that 10 years from now, the monetary system is going to look the same as it does today. I don't think it will. But I would agree that the dollar will still be the dominant currency when that happens. The other thing I'd say is I think a lot of people look at this divorce and they automatically think, well, I'm going to go with Apple because Apple's the cool kids. That's the new thing. But, I know people that worked at Apple. Steve Jobs wasn't the nicest guy in the world. He was in many ways a dictator, right? And he got fired, by the way. And Apple went through some really tough times along the way. And so I think that's important to remember when we have these de-dollarization discussions and where's the world going to be in 10, 15, 20 years. I think everybody knows that historically empires rise, empires fall. Global reserve currencies don't last forever. But I talk to a lot of people who know this and think that transition happens quickly and peacefully. And my biggest argument with the whole de-dollarization topic is that I think many people think that it's a foregone conclusion. It's automatically going to happen, that those who are de-dollarizing are going to win, and those who are staying with the dollar are going to lose. And, that's going to be this beautiful new day and the world's going to, be better for it. And I can't rule that possibility out. But when I talk to people, I feel like they have that as a high probability event. And what I have as a high probability event, that any transition that ends up either putting another system on par with the dollar or replacing the dollar will be incredibly economic. We'll see incredible economic volatility, and it will probably see military violence. And in that process, I think the dollar goes a lot higher. So I don't think that we will have a situation where Microsoft and Apple both continue to develop and operate peacefully alongside each other and, no problem. So I think it's actually a very good analogy. I think it's a good way for people to understand it. I just want to caution people that just because Apple is the cool thing in the real world doesn't mean that Apple would be the cool thing in this scenario.
Louis, would you be able to give us a summary of your view of what especially China is planning, so what the playbook is here? You wrote a very interesting article, or you mentioned, the Beijing running the People's Bank of China, like the Germans were running the Bundesbank, which is something that triggers the Austrian and the Germans very much. Could you explain what you mean by this, and maybe give us your view of it doesn't matter if it's really happening. The question is, what do you think is China is planning, basically?
Yeah, no, look, I think, to Brent's point, that, any transition is unlikely to happen without military violence. I agree. And I think we've actually already seen some of that over the past 30 years. The invasions of Libya, the invasions of Iraq didn't come into a vacuum. The reality is, perhaps one of the bigger disconnects around the world is if you go to the U.S. and you ask Americans, what's America's biggest comparative advantage? They'll say, oh, we have the rule of law, or we have the world's best universities, we have the world's best entrepreneurs, or, all of which happens to not be wrong, or, nobody can invade us, or we have lots of natural resources, food, energy, etc. Again, all of which happens to be true. And then if you ask a foreigner, what's the U.S.'s greatest comparative advantage? 99 out of 100 foreigners will say, well, the U.S. has the U.S. dollar. It's the world's reserve currency, which means that the U.S. can basically fund budget deficits and current account deficits with absolutely no constraints, as we saw during 2008, right? The policy response that the U.S. adopted following the mortgage crisis of 2008, running massive budget deficits while running also big current account deficits, no other country could have done. So the U.S., and as a foreigner, I think, look, the U.S.'s greatest comparative advantage is the U.S. dollar. And I think that Chinese policymakers feel the same way. They look at the U.S. and they think, okay, here's a power that is now openly hostile to us. Why do we need to basically keep funding their growth by using their currency? Now, Xi Jinping, I think, has he's a transformational president for China in many ways. But the number one way he's a transformational president is he's really the first outward-looking president in China. I think since Mao Zedong, every president that came in and said, okay, I got so many problems at home, I don't really care what's happening abroad. I got so many things to tackle here. I'm not going to waste my time, traveling abroad, figuring out what's happening elsewhere, etc. I got a full plate of domestic problems. When Xi Jinping comes in, his very first speech is all about the One Belt, One Road, the Silk Road Fund, the Asia Infrastructure Investment Bank. It's a very imperialist vision of China's future. And when I say imperialist, I don't mean that China's going to go and invade the Philippines or Indonesia. It's that the history of every empire is fundamentally a road building exercise. You build roads to bring in commodities cheaper and to push out finished goods, higher value finished goods, to the outer realm of the empire. That's what every empire does. That's why in Persia they said Darius is a traitor. That's why in Europe we say all roads lead to Rome. Empires build roads. Now, once you've built the road, there is no reason. Well, you don't want the trade on that road to be denominated in US dollars. You don't, because you end up basically paying tribute to your biggest geopolitical rival. So along with China's imperial vision of its future, it has no choice but to try to de-dollarize emerging market trade. If it wants to embed itself in the growth of Central Asian countries, Southeast Asian countries, African countries, it has no choice but to de-dollarize the trade, and frankly, to try to move it in renminbi. Now, to do so, to move the trade to renminbi, the renminbi needs to be a decently structurally strong currency, and most importantly, the RMB bond market needs to be a store of value in its own right. And here I'll just I'm sorry I'm a bit long-winded, but currencies serve three functions, right? They serve a means of exchange, a unit of account, and a store of value. Now, store of values can be bonds, they can be equities, but most, central banks, if you're the Thai central bank, if you're the Korean central bank, and the PBOC comes knocking on your door and says, hey, let's trade in renminbi, in essence, you're saying, hey, keep reserves in renminbi at your central bank. And they will only do that if they have a conviction that those RMB bonds will hold their value. And so for the past 10 years, and this is, of course, what Germany did in the 1970s in Europe. You know, in the 1970s, Europeans complained to the Americans saying, hey, look, you guys are debasing your currency. And the Americans said, well, the US dollar is our currency and your problem. In essence, go pound sand. And what the Europeans did was moved all their trade from US dollar and all their savings from US dollar into Deutschmark. And using that roadmap, this is what China's been trying to do. And this is why, if you look at the past 5 years, the Chinese bond market has outperformed the US Treasury market by 40%. It has been a policy setting. It's been a policy choice by China to favor the bonds, hold the currency steady at the expense of everything else, just like the Bundesbank did in the 1970s and 1980s. Sorry, long-winded answer.
Brent, do you wanna say something on that? Otherwise, I'll jump to a different topic. Sorry.
No. So
yeah, go ahead.
So again, I totally agree with Louis' characterization of what China is trying to do. I don't have any issue with what he has laid out so far. Where the issue for me comes in is when people jump to say that just because China's trying to do this, that they will be able to successfully do this. I think it's going to be much harder to actually pull off in the real world than to write it in a book. And as an example, part of the reason that China's bond market has stayed relatively flat for the last 4 years, or whatever number Louis quoted, is because they still have a quasi-pegged currency. And they have kept rates where they are because they largely shut down the economy and have only recently reopened. And there's not a large amount of external holding of RMB bonds. There's some, but to a large extent, it's still internal. The other thing is that even though they've done that, the Chinese yuan has lost 15% of its value in the last 2 years. And so when people will often tell me that the rest of the world is no longer going to hold U.S. bonds because the dollar is going to lose value and they're going to start using the yuan, even though the yuan has lost 15% of its value versus the U.S. dollar that everybody thinks is losing its value. The other reason that Chinese bonds have outperformed the United States bonds is because the U.S. purposefully weaponized the dollar by raising rates. And when you raise rates, bond prices fall. Now, I'm no fan of central bankers, and I know many people out there are not fans of central bankers, and many people think they're fools. But however foolish you think they are, I promise you that they know when they raise rates, bond prices fall. So this idea that the U.S. is shocked at the performance of the treasuries over the last 2 or 3 years, and they couldn't have seen this coming is, in my opinion, just way off base. Of course they knew the bonds would fall in price. They wanted the bonds to fall in price. And because, again, that goes along with the dollar getting stronger. And I will argue till the day I die that the U.S. has purposefully weaponized the dollar over the last couple of years. And higher interest rates, a lot of people will say, use the higher interest rates in the U.S. and the blowing out of the budget in the U.S. as evidence that the dollar just can't last forever. And listen, I think anybody who looks at the trajectory of the debt and the budget deficits in the U.S. knows this is a problem. But based on where the world is right now today, now this may change, but as of right now today, higher rates in the United States affects the rest of the world more than it affects the United States because the whole world uses dollars. Now they're starting to use Apple as well, or they're still, the whole world uses Microsoft, right? Now they're starting to use Apple, but they still use Microsoft too. And they have all taken out loans from Microsoft. And they owe all this money back to Microsoft. So in other words, the rest of the world owes over 30 trillion in US dollar denominated debt. They owe another 80 trillion in off-balance sheet derivatives in dollars. So I don't see how we can transition from using Microsoft to Apple. And if everybody starts using Apple, where are they going to get the money to finance and service and pay off all the US dollar debt? So in other words, the process of de-dollarization, if it in fact takes place, pushes the US dollar higher. It doesn't push it lower. Because if you start using the US dollar less, that means there's less circulating. If there's less circulating, there's less supply. But all that historic US dollar debt still exists. So I can't figure out how we can transition from one system to another, or even have dual systems where less trade and less circulation of US dollars takes place without reconciling all that outstanding US dollar debt. And, you know, that honestly, that Eurodollar system that, by the way, the rest of the world adopted on their own, the US didn't force it on them. Until that gets reconciled with, I think we have the US dollar to contend with.
Brent, would you say that, you know, year to date stocks are up, rates are up, the dollar is up, gold is up? Would you say that the dollar milkshake is actually in full swing at the moment? Or is it just, you know?
No, I think it's very visible this year. But the reality is, if you look back since I first started talking about this, 2018, 2019 period, over that time period, the dollar's up 8%, gold's up, I think, 30 or 40%. Equities are up 40 or 50%, and rates are up. And so that is the dollar milkshake. And over that time period, the U.S. has largely outperformed the rest of the world. Now, of course, and the interesting thing to me is, you know, one thing Louis said, again, which I totally agree with him. He said all of the increase in trade is coming between emerging markets and emerging markets. I totally agree with that. But all the real growth in the world is coming from the United States. I mean, of course, there's exceptions, but in general, the majority of the economic growth in the world is coming from the United States. And the other thing, you know, with China, again, because I think a lot of people, and again, I don't really have a problem with China. I have a problem when people automatically think China wins in this scenario. You know, over the last 10 years, the Chinese stock market, or from its high, I think the Chinese stock market's down like 60%, right? And it's down like 30% from where it was when Xi first took over. You know, the renminbi's down 15%. Their real estate market's down 60%. I don't see how China's winning in this scenario. You know, I can guarantee you, if the numbers I just quoted applied to the United States and not to China, I would be getting emails, DMs, Twitter messages all day, every day. See, the empire's falling. I don't know what you're talking about. But because it's China, people ascribe this, it must be some 3D chess move that we just don't understand, but this is actually to their benefit. And again, I think everybody needs to take a more, what's the right way to say it? A more neutral view. I mean, nobody knows how this is actually going to play out. But I tend to get in these discussions or arguments, however you want to describe those, when people have an absolute view that just cannot be different.
One quick question for both of you. What does winning even look like?
Well, that's a very good question. I'll just answer it really quickly. I think for the U.S., I think the status quo, if the status quo largely remains as it is, I think that is the U.S. winning. I mean, that's how again, whether that's a win or not, I think you can debate whether that's actually a win. But I guess in this analogy that we're using, I guess that's what I would characterize as the U.S. winning.
I would say, look, there's so many different ways you could say winning. I would say starting off, providing better life outcomes for your citizens, right? That should be number one. So perhaps the first hurdle should be to not have a falling life expectancy and not have a life expectancy that's at a 30-year low, which is where the U.S. is today. To not have a rising infant mortality rate, instead of have a falling infant mortality rate. Perhaps winning is not having 1.5% of your population in prisons. I mean, lots of different ways. Perhaps it's not having a Gini coefficient that is increasingly looking like an emerging market Gini coefficient. So I think part of the reason people latch on to the idea that the U.S. is struggling is because they don't rate what the country is doing on what the stock market is doing, but on what they see with their own eyes, with homeless crisis in major U.S. populations, with rising crime, with all these social factors that seem to show a society that feels rather sick, right? I mean, the US today has the same life expectancy as it did 30 years ago, while spending as a percentage of GDP twice as much as it did 30 years ago in healthcare. So now maybe none of that has to do with the currency. So, but the reason I highlight this is that I think when Xi Jinping came 10 years ago or 11 years ago to power, and, Brent said, the stock market is down, 30% since then. I don't think Xi Jinping cares where the stock market is. Like, I really don't. I think in his long list of things he wanted to get better, it's not that the stock market was at the bottom of the list. It wasn't even on the list. I think what was on the list was moving more of China's trade to renminbi and to reduce the dependency of its economy on the dollar. Which it has been doing rapidly. And, this does take sacrifices. And if it means sacrificing the stock market again, Xi Jinping doesn't care for a very simple reason. And that is that while in the US, 70% of people own stock directly or indirectly, in China, it's between 10 and 12% of people who own stocks. And it's mostly the very rich. So if it goes down, it's like, who cares? It doesn't have the sort of social impact it has in the US. Not only that, but most companies in China don't fund their growth through the stock market. So I do think a lot of people look at China through the prism of the stock market, but again, I'm not sure it's that relevant to the leadership. They don't benchmark themselves on this. They're not like Donald Trump was tweeting each time the Dow Jones was up 150 basis points, saying, "Look at me, I'm doing a great job. The Dow's up 150 basis points." So it's a very different perception of how you judge yourself. But this goes back, and I think this is really at the crux of this discussion is, again, what is a currency? Again, it's a means of exchange. And, within the dollar is definitely a means of exchange. And, within Asia, and within China, the renminbi is, of course, a means of exchange. It's a unit of account, but most importantly, it's a store of value. Now, historically, if you've been a foreigner, you held US dollar, as a store of value, and you held it in one of two ways. Like, I think over time, we all know that fiat currencies, they go down over time, right? I mean, accumulating banknotes in a safe is a pretty shitty strategy. So as a store of value, when you get your currency, really you either have to put it in bonds or equities or real estate, but, let's just do bonds and currencies. And for the longest time, if you were a central bank, if you were a foreigner like me, and you looked at your US dollars that you earned because the US runs an $800 billion current account deficit every year, so you earn US dollars, you had two choices. I can put it in bonds, I can put it in equities. And if I thought, okay, for the next 5-10 years, actually both looked okay. And you had a period of 30 years where you were making money on both bonds and equities if you took enough of a long time frame, if you had a long time frame. Now, for the first time, we're looking at a 5-year loss period in bonds, in U.S. bonds. Bonds, U.S. treasuries are no longer a store of value. Now, fortunately, U.S. equities have been a terrific store of value. So while bonds have been a horrible store of value, U.S. equities have been a terrible store of value. Now, in China, it's been precisely the opposite. Bonds have been a terrific store of value, and equities have been a terrible store of value. Now, again, this goes back perhaps to the fact that if you're China, you're trying to convince central banks to buy your currency. You're trying to convince other governments, and they're going to buy bonds. They're not going to buy equities. If you're the U.S., you don't have to convince anybody. It's there. Now, this means, nonetheless, that if ever we move to a period where U.S. equities start to go down, where they stop becoming a store of value, which, happens every 5-10 years, U.S. equities go down, then we best hope that bonds become a store of value again in the U.S. Because if we move to an environment where people are losing money at the same time on equities and bonds for a meaningful period of time. We've had this over the past 3-4 years where, for 3 months you're losing money on equities and bonds. You had it for 6 months in 2022. But if you have it for a year or two, if you have it for a meaningful period of time where, you're losing money on equities, you're losing money on bonds, then all of a sudden there will be a much bigger question mark of people saying, hold on, is the US dollar still a store of value for me? And I'm not saying this will happen. I'm saying if we do, this is the Damocles sword hanging over the dollar's head today. It used to be, held up by 2 pillars. Bonds are strong, equities are strong. Bonds are gone. You're being held up by 1 pillar. You lose that one, the edifice collapses.
I mean, we will be writing about the end of the 60/40 portfolio at length in our report, and this was basically, the foundation for the strength of a 60/40 portfolio was basically due to the great moderation. Inflation not being a real concern for your portfolio construction. Now, obviously, that has changed, and I think Louis, you once made the comparison. It's like we're now in the same predicament as the Chicago Bulls without Michael Jordan and the French national team without Zinedine Zidane. So you have to rebuild that team. Now, let's briefly talk about gold, because perhaps gold might be this sort of portfolio diversifier, and this year's report will be called the new gold playbook. So actually, many things that used to be like iron laws in the gold world, they just don't work anymore. Now, Louis, you said before that Xi Jinping doesn't care about where the Shanghai Composite or Chinese equities are trading. Do you think that he cares about the price of gold? Because China, obviously, China has purchased, the People's Bank of China has purchased roughly 200 tons over the last couple of months. I think 17 months in a row with straight monthly purchases. But still, it's at the moment, I think 4.3% of the total reserves of the People's Bank of China, while globally it is 13%, and obviously the US holds like 70% of its reserves in gold. So there would be lots of room for the People's Bank of China continuing to step up their gold reserves. And I found this great quote by a Chinese official who was actually asked and why the People's Bank of China holds so little gold. And he said, China owns gold through its people. Well, I thought that was a really, really interesting thing. And as we all know at the moment, Chinese are buying gold like crazy. So it's not only, the central bank side, but it's also private individuals. We've got this thing coming up with the gold beans for the Generation Z. We've got big inflows into the ETFs. We've got strong flows from the banks. Do you think that gold plays a role for the Chinese, or is it perhaps a little bit overemphasized by the gold community?
No, look, I think to answer your question directly, I don't think Xi Jinping cares about the gold price. I think gold for him, I think what Xi Jinping cares about is reducing China's dependency on the US dollar and de-dollarizing emerging market trade. That's what he's looking for. In that respect, gold is a means to an end. Now, to your point on China buying gold, China, if you look at, I've made that point like hundreds of times over the past 20 years. Gold at the end of the day is 2 things. First and foremost, it's a play on emerging markets. You look at where physical demand for gold around the world is, it's all emerging markets. Basically, a third of gold demand is China, another third is India, another 20% is the broader Middle East, and then throw in 10% for Russia and the ex-Soviet states. The people who buy physical gold are by and large in emerging markets. So emerging markets do well, gold does well. Emerging markets do badly, gold does badly. Now, of course, a lot of people say, well, that's because, gold is also inverse US dollars. Emerging markets are inverse US dollar. But look at the past 18 months as an example, the US dollar has been strong. Emerging markets ex-China have been super strong. India's booming, Indonesia's booming, Middle East is booming, etc. Gold demand has been strong. It has gone up in the face of a strong dollar because, again, like emerging markets, when emerging markets boom, gold booms. Now, of course, when the dollar's weak, emerging markets tend to do even better. But you don't need the dollar to be weak anymore for emerging markets to do well, which is, a very important change that we're going through. So that's number one. That's the first function of gold. The second function of gold, which is the one that Westerners typically focus on, is it's basically a call option on the world falling apart. And that might be for wars, for geopolitical reasons, for financial crises. You can paint any bad scenario you want, but gold is often seen as a sort of as a call option on this. And I think we've had a glimpse of it. You said, China's been buying a lot of gold, and that's true. But actually, the big new marginal buyer hasn't been as much China as it's been Japan. And I've written a number of pieces on this in the past couple months. I think if you go back to early March, the BOJ says, we're going to sit on the yield curve forever, which goes against market expectations. The yen moves from 146 to 155 very quickly. And the Japanese start buying gold like crazy. And you can check this. There's a gold ETF, 1540JT, the main gold ETF. It's like GLD, but in Japan. All of a sudden, the volume on this thing went up 5x, and it started trading at a 10% premium to NAV. And so I think what you saw there, as far as Japan was concerned, was that sort of second option. Like, again, you got the emerging market story for gold, and then you've got the sort of call option on whether you call it financial repression, geopolitical crisis, whatever. That call option on gold got cashed in Japan. And that to me raises an interesting question, because as people look at Japan, they look, the yen's collapsing, it's too much debt, the central bank can't do anything, can't raise interest rates because of too much debt in the system, et cetera, et cetera. You've all seen the scenarios over the past few weeks. But, is it too much of a stretch to think that's what's happened in Japan could happen elsewhere? Why can't it happen in Europe, where, right now France is running a 5.5% budget percent of GDP budget deficits at a time of full employment and at a time of we're 3 or 4 years into an economic recovery? Why can't it happen in the US, where we've got full employment and budget deficits of 6% of GDP? Pretty unprecedented. Now you could say, well, the stock of debt isn't as high in the budget deficits may be bigger in Europe and maybe bigger in the US, but the stock of debt isn't as high. But then that's just a question of time. With these budget deficits, we'll get there soon enough. Not only that, the ownership structure of the debt is very, very different. A third of US debt is owned by foreigners. 4% of Japanese debt is owned by foreigners. So it could, more than 40% of French debt is owned by foreigners. So things can move much quicker in these other countries. But long-winded answer to your question: do the Chinese government care about the gold price? No, they don't. For them, gold is a means to an end. It's a mean to both give some credibility to the currency, and to basically de-dollarize their trade. They can tell people, look, we'll trade in renminbi, and if you don't want to keep the renminbi, we'll trade you at the Shanghai gold market. You can bring your renminbi and we'll give you gold. And if you're a Russia, if you're a Kazakhstan, if you're a Middle Eastern country, that has a lot of attraction. Now, how can China do this? Of course, it is the biggest gold buyer in the world. It's been importing roughly a third of global gold production every year. It is also the biggest. Most people don't realize this, but China is the biggest gold producer in the world, which perhaps helps explain your point that the central bank governor is saying, well, we're okay on gold. They have a ton in the ground. Like, people underestimate this, but China has a ton of gold in the ground. So they probably feel if we ever need to get it out, we can just throw more people at it, and throw more people, throw more money. And we'll get the gold out of the ground. For now, it's in the ground. It's fine. In the same way that, say, Canada doesn't have gold reserves in its central bank. It's like, if you're Canada, why bother having, getting the gold out of the ground to put in a safe? It's right there. If we need it, we can go get it.
Brent, any thoughts on
Yeah, so
all the?
I have a couple thoughts on that, and it kind of, I want to refer back to something, a topic we talked about just prior to this, and then I'll bring it into this, and that we were talking about what does winning look like, right? And what I probably should have said, and I don't know if you guys will agree with this or not, but in my opinion, from a certain point of view, and I don't really like this view, but the reality is that whoever wins, winning means that the government stays in place, right? It means that, the U.S. government is still the U.S. government. It means that the PBOs, or it means that the CCP is still in power in China. It means that Putin and his party is still in power in Russia. And while I think it's nice to think that our leaders, governors, presidents, however you want to classify these people, have our best interests at heart, they don't. Right? So the idea that they're only going to put policies in place that benefit their citizens rather than benefiting their own personal power or their personal power or their government power structure, I think is extremely naive. So from that perspective, I think the number one goal for the United States is to stay in power and to stay as the global hegemon. I think China's number one goal is for the PBOC, or I'm sorry, the CCP to stay in power. I think in Russia, it's for Putin, and on and on and on, right? So I think we are in an era now where it's kind of this whole Game of Thrones, and everybody wants to continue to rule their house, and everybody wants to take over more territory of the overall kingdom, right? Come what may. So now, as it relates to gold, I absolutely think gold is a big beneficiary of all of this madness. And I think the price of gold will go much higher. But one thing I would say is that when I hear somebody say from China, somebody from the CCP in China say, our citizens' gold is our gold, right? I kind of think back to, people often say, well, the U.S. confiscated their citizens' gold. And listen, they would absolutely do it again if they had to. But the idea that they wouldn't do it in China, I think, is completely wrong. Of course they would. And they would do it in Russia, and they would do it in Brazil. They would do it everywhere if that's what they had to do to stay in power. The other thing I'd say is part of the reason that there has been so much demand for gold in Asia, and specifically in Japan recently, is because their currency is not the US dollar. When people in Asia buy gold, they're not going and buying gold and say, Jesus Christ, Jay Powell is out of control. He's going to kill the dollar. When somebody in China goes to buy gold, it's because the yuan is losing value. When somebody in Japan goes to buy gold, it's because the yen is losing value. And while the dollar may be a secondary concern to them, their everyday living expenses are the primary driver to individuals buying gold. Now, from a central bank perspective, I think they buy gold for a couple of reasons. One is I think they know, just like we know, that fiat dies over time. I think they know, like we know, that not only does fiat die, but even if it doesn't die, it's going to lose purchasing power. I think that they know that their currency is not the US dollar, and they can't just go buy whatever they want with their currency, so they need to have another form. And I think they don't necessarily want to have all of it in dollars for the reason that many people have cited over the last couple of years is what the United States did to Russia in confiscating their reserves. So I think everybody's looking for a way out of the Microsoft system, right? And I think gold is one way they try to accomplish that. And I think gold is, I've said this many times, I think gold is probably the most important part of anybody's portfolio. But I don't think gold is a silver bullet, pardon the pun, that just solves everything. And so, again, when I'll get in these discussions and people say, oh, well, just use gold. Well, it's not that simple, right? I mean, gold is not easy to move around the world. Yeah, it can be done. It can be settled in gold and shipped. But is China really going to, after getting all this gold into China, are they all of a sudden going to start shipping it abroad to settle their trade balance? I kind of have a hard time believing they will do that. Maybe they will. But it's not a given to me. The other thing is, gold's been used for centuries, and of course it can still be used, but it's not as efficient, and it's not as easy, and it's not as quick. So it's a contingency plan. But as of right now, until a new system is put in place that features gold as part of the system, using gold will not be as efficient as using the current system. Now, perhaps there will be countries that will use it, even though it's not as efficient, because they think in the grander scheme of things, this will help them de-dollarize. Totally understand that. But again, think of all the times over the last couple of years where some of these periphery countries have tried to use gold, and it ended up failing on them. And so, again, this isn't Brent hating on gold. This is, I think everybody should own gold. I think it's an extremely important asset, but I don't think it solves all the problems that many people think it solves.
To Brent's point, if I can jump in here, I think if we go back to the to the initial Bretton Woods days, France had its gold in New York, the UK had its gold in New York, the Germany had its gold in New York, and when trade needed to be settled, and they each basically had that little cubicle, and when trade needed to be settled, you move it from the UK box into the French box.
Have you been there, by the way? Have you been to the Fed?
No,
it's actually pretty cool. You should go see it sometime.
So you just move it. You just move the gold bar from the French box to the U.S. box, or and so some such. But the whole point today, of course, and to Brent's point, I think it's important. The reason I'm turning back to gold is because I think of a loss of faith, partly in global institutions and in the U.S. and in global institutions in general, and in the U.S. in particular, because of the Russian sanctions. I think that was an absolute game changer. So now the odds that China will say, you know what, I'll keep all my gold in New York, and I'll trust the New York Fed to move my gold bar from here into the Russian box, or into the Kazakhstan box, or into the Pakistan box. Yeah, that's not going to happen, right? Now, granted, what China could do is say, look, we're creating our own set of boxes here in Shanghai, and where we will move. We'll have a Pakistan box and a Kazakhstan box, and a this box and a that box. And now, of course, that would imply that Kazakhstan, Russia, Pakistan, and all these countries feel okay trusting China. To be the box holder. France, Germany, until at least de Gaulle decided to take his gold out, they were all happy to trust the U.S. to do that job. Will people feel that comfortable with China? And here I think that goes back to the other side of the Belt and Road, which is, we're going to come in and build you a railroad. We're going to we're going to come in and build you a nuclear power line. We're going now. A new nuclear power plant. We're going to do all these things for you, and you're going to pay us back over 20 years. So now all of a sudden, there's more dependency, right, between China and all these countries. China just built a high-speed rail line in Java that Indonesia is going to pay back over 30 years. Now, China could say, well, look, if I confiscate your gold, you stop paying me on the train, and we're even Steven. So you create these level of dependencies, just like the U.S. did post-World War II, right? The U.S. post-World War II said to everybody, look, we'll give you money through the Marshall Plan. We'll lend you money. You use that money to buy back Caterpillars, and you pay us back over time. And it worked great. And China's using the same roadmap. Now, whether people trust it or not, is the open question. Some may not have a choice. Russia today probably doesn't have a choice. It's on the ropes, so it doesn't have a choice. Kazakhstan probably doesn't have that much choice either. It's bordered with Russia and Ukraine, and Russia and China. What else can it do? So there's countries that you've got more or less on the ropes, countries less so. The reality, though, is that it is slowly building up, and more trade is starting to be settled.
Can I just intersect this? So, who do you trust when you trust China? Do you trust the party, the state? Do you trust Xi explicitly, like specifically? Who is it that you plan the next?
You trust the party. They will tell you. They'll tell you the party and the state are basically the same thing, and the party actually stands above the state in the Chinese constitution. So inherently, you trust the Chinese Communist Party. Now, conceptually, you could say China could evolve over time, and the state will always remain there, and the party can come and go, and the Chinese state will stay there. But in the party's own ideology, that's an impossibility.
Can I just do one other really quick question, because it has not been mentioned here so far for both of you? does anybody care about Europe? Like, because, you know,
Well, Brett does. He's got a French map behind him.
I just want to say, because you were talking
France
about
and Spain.
you were talking about divorce before, and I said I thought, okay, this is like a little bit like a ménage à trois, like a threesome, where that usually doesn't work at all. And it seems that Europe is just, just losing in between those two big blocks, being China and the US, obviously. But I think we're all very.
Can I?
Sure.
Can I
So
take this one?
do we see more of a de-euroization than a de-dollarization, perhaps? Isn't that more accurate?
In my opinion, yes, and for a couple very specific reasons, I think. And this goes back to what I said at the beginning: is that this world is going through a divorce. Again, this is kind of how I look at it, but this is a mutually desired divorce. I think the U.S. wants to decouple from China, but I also think China wants to decouple from the U.S., at least largely. Of course, they're always going to do business in some form, right? But I don't think this is just all driven by the East. I don't think this is all driven by the West. I think in many ways we've gotten to a point, again, where we're in this Game of Thrones and sides are being chosen, and we're saying we're no longer going to live peacefully together. Well, hopefully we live peacefully, but maybe not. We're not going to live cooperatively together. And so China isn't doing many things to say cut itself off from the West is probably too strong, but insulate, I think, from the West would be a good way to say it. And they used to get a lot of stuff from Europe. And Europe, again, I think there were a lot of people who thought that when the chips were on the ground and all the cards were on the table, that Europe would side with Russia or China and go against the US, but that's not the case. And so, in many ways, China pulling back from the West is hurting Europe. And I also think that the U.S. is, for the most part, sacrificing Europe. And I think it's by design, and I think it's a matter of policy. And you can see this happening. You can see industry is leaving Germany at kind of an alarming scale. And some of it's going to China. Some of it's going to the United States. I was talking to somebody. It actually might have been you, Ronnie. I was talking to somebody about, and they had been to some conference in Germany. And it was like this entrepreneurial business conference or something. And all the really smart people were leaving Germany, and they were going to Liechtenstein. They were going to Switzerland. They were going to other places in Europe, and they were going to Dubai. Exactly. And so this isn't just, Brent read an article. This is literally really happening. Right. And Europe is really kind of getting in this divorce. I think Europe is getting the worst end of all of it. And I don't think that's going to change anytime soon, which I hate to say it. I mean, I think anybody who's spent any time in Europe tends to love it. But
so Europe is like the really tough spot. The kids that are basically left in this nasty divorce.
That's right.
That's a great point.
That's right.
And Brent, just one thing. A friend of mine who's in the car industry, he told me, you've got no idea how many Chinese cars you will see over here over the next couple of years. Yeah, it's just mind blowing what's going on in the car industry. And that's like for the Germans, the BMW, Mercedes, Porsche. That's like really their industry that they're most proud of, and where they're now being really attacked. So that's I would agree, and I think we all kind of agree that Europe is the big loser in that big game. But Louis, you made an interesting point.
As a European who left Europe, the kind that Brent described. Let me butt in. I think there was a terrific role for Europe to play in this divorce. It could have been the middleman. It could have stood there. And I think through policy failure, we've basically completely failed to do so. To be honest, there's a quote from Tolkien that from the Lord of the Rings. I'm showing my geekiness here that I really love.
I love it.
The quote is, at the beginning of the book, they go why the 3 rings were forged, and the idea was that 1 ring will always corrupt, 2 will divide, but with 3 there is balance, and that's basically how the book starts. And I think, to be honest, you had this unipolar moment in the U.S. And you did have massive corruption in the U.S. And you did have, stupid wars, runaway government spending, massive regulatory capture. When you're the unipolar superpower, you get away with doing a lot of stupid stuff for a long time, and the U.S. got away with it for 20 years. Policy mistake after policy mistake. I think we had a chance to move to to have three rings of power, to have Europe, to have China, to have the U.S. But we failed. Europe failed. And so we now end up, to Brett's point, in a two-ring world with division. Again, one ring will always corrupt, two will divide, and with three there is balance. Now, I think the coming years are going to be very challenging for Europe. There's the fact you already mentioned, that China in the past 5 years has massively moved up the value chain in terms of its production. China's trade surplus has gone from 20 billion a month to 70 billion a month, not because all of us on this call are buying 3 times as many plastic toys for our kids and 3 times as many pairs of sneakers. The reality is China's trade surplus has tripled because China's become the biggest car exporter out of nowhere. Nobody thought that possible 3 years ago. The biggest earth moving equipment exporter, the biggest tractor. China's become an industrial powerhouse in its own right, and the productivity in a lot of these sectors has been absolutely dumbfounding. Now, the problem with industry, both the problem and the advantage, is you create an ecosystem, and it feeds on itself, and it's having an industrial ecosystem is very hard to put together. But once you have it, it tends to be a massive comparative advantage that again builds on itself. Today, China is the world's leading industrial powerhouse, and it's going to be very hard, and it is going to tear apart most other industrial countries. And it's going to be very hard for people, A, to compete, and B, to catch up. Now, I think the only way you can compete will be by having a crazy cheap currency. And this brings me to Japan and to Europe's big problem. Europe cannot live with a yen at 160. It can't even live with a yen at 140, to be honest. But a yen at 160 is going to kill Germany, it's going to kill Sweden, it's going to kill Switzerland, it's going to kill France. A yen at 160 plus the competitiveness in China, that's like a 1-2 punch. Like most businesses can sustain one punch, it's the second punch that knocks you down. Europe is going to take a 2-punch hit here. The 160 yen, the competitiveness from China on the other end. Now, let's not kid ourselves that the U.S. won't face the same punch. I think if you look at the latest GDP numbers, you now have in the U.S. an inflation rate. PC was I think it was 3.6 or 3.7. U.S. GDP was 1.6. You now have an inflation rate that's twice the growth rate of real GDP. That is not a sign of a healthy economy. It's also a sign of an economy. One of the reasons I'm very bearish the dollar today, aside from the geopolitics, all the conversation we've been having, the U.S. today is crazy expensive. You go travel in the U.S. from anywhere else in the world, and oh my God, everything is just stupidly priced here. The prices all feel wrong. Now, my whole life, and my wife is American, she's from Oklahoma, so we go to Oklahoma a couple times a year. I'd go to somewhere like Oklahoma, and I'd feel oh my God, they can't give it away. It's as soon as you left New York or San Francisco, the U.S. always felt super cheap to me. Again, New York, San Francisco were expensive, but those were sort of pockets. And the broader scale of things, the U.S. was super cheap. Let's not kid ourselves that this is the case today. Now, you go to Japan, you cannot spend money if you try, which is the opposite of what I've known my whole life. It used to be, when I first moved to Asia, if you went for dinner in Japan, you had to check your bank balance before you went out. This is no longer the case. And Europe is stuck somewhere in between. It's not super cheap, not super expensive. The U.S. is super, super expensive. But you go anywhere in Asia today, the comparative advantage that they have, both in terms of the productivity of their industry and in terms of the cost of goods, is just the gap is too big.
Can I? Sorry, Brent. Yeah.
Go ahead. Go ahead.
Go, Brent.
Well, Louis just made me think of something. And I think this is, at least from my point of view, this is important to point out. We're talking about so-and-so is going to take a hit, and Europe's probably going to get the brunt of it, and then China's going to take a hit, and the U.S. is going to take a hit. Like, this is the point. Like, we're all going to get hit. And I don't want people to think that the U.S. is immune here. I think the U.S. is going to get hit hard. I really do. But I don't think it's a given that the U.S. quote unquote loses the overall hegemony as a result. I cannot figure out a situation where the U.S. gets hit hard and China does not get hit hard, and Europe does not get hit hard, and Japan does not get hit hard. And I think it's easy to say that all the kids on the playground are going to gang up and go beat up the bully, and everything's going to change. And I think the point I want to get across is bullies exist because that's usually not what happens. Bullies exist because people usually back down to the bully. Now, eventually, bullies fall, but they don't always fall right away. And I think part of the reason I have a tough time seeing de-dollarization happening en masse in a quick form is because I think to do that, again, China needs to decouple from the U.S. for that to largely happen, I think. And I think in that process, all of this amazing, capacity and productivity that Louis talks about, I don't deny that exists. But I don't think that the markets exist outside the United States in such a size that they can sell all that productivity and they can sell all that production to at current prices. So in other words, they can sell that stuff to the U.S. because the U.S. is strong, to Louis' point, and because the dollar is strong. If they had to sell all that productivity and all that production to other parts of the world whose currencies weren't strong and whose markets aren't as big, they can sell it, but I don't think they can sell it at current prices. And it's not only the U.S. that has taken out a lot of debt over the last 20 years. China has taken out a lot of debt over the last 20 years. And they took that debt out based on current prices. So if they have to start now selling to new markets at lower prices, I don't think the profits from those new markets at lower prices are of a size that can efficiently service and pay off all that debt that they took out. And I don't think people realize how much debt China has taken out over the last several years. Now, Russia is kind of an outlier here. Russia hasn't taken out a lot of debt, and Russia has enormous natural resources. And that's part of the reason why Russia, despite the sanctions, despite the, whatever you want to call it, the positions that the West has taken against Russia, has done pretty well, or at least been able to hold on longer than many expected. I don't know that if we continue on this path of decoupling East versus West, I don't think that China can hold on as well as Russia has held on. That's my, now Louis may feel differently, but that's my view.
Yeah, so I think on debt, for me, I look at debt a little bit differently. I think the China debt and the U.S. debt, or frankly European debt, I would log U.S. and Europe in the same basket in terms of debt growth. They're very different in two respects. The first big question mark is who's on the other. Somebody's debt is somebody else's asset, right? And so it's who's on the other side of the debt. Is it domestic or is it foreign's? Or to put it this way, if I borrow $1 million from my dad, as a family, we really don't have any debt. It's now if I borrow $1 million from Brent, I owe Brent $1 million. Now, you look at the growth of debt of the U.S., the growth of debt in Europe. Now, in Europe, it depends on the countries, but the countries where you've had the fastest growth of debt, like France, it's increasingly being more and more to foreigners. And when you owe foreigners, your policy choices narrow down relative to when you owe yourselves. When you owe yourself, you can always kick it down the road, as the Japanese have shown really for a very long time. So that's number one. Number two, the other question, of course, is what do you do with your debt? Now, when I started in this business, the U.S. had about a $4.5 trillion government debt. Today, it's got 34 trillion government debt, so it's added 30 trillion through the space of my career. And when I always ask myself, what did the U.S. get for that 30 trillion? Where's the Hoover Dam? Where's the interstate highway system? Where's the high-speed rail link? The reality is a lot of that debt has gone either to fund highly unproductive foreign wars, highly unproductive in terms of everything, of course, but mostly in terms of America's prestige. And it's going to fund social transfer payments. Now, I don't want to sound like I'm name dropping, but in 2008, I had a meeting with the then Hong Kong financial secretary at the darkest day of the darkest hours, like December 2008. Lehman had gone bust, world was falling apart, and Hong Kong's a financial center, and people were getting laid off by the thousands. And I asked him, it was a one-on-one meeting. I said, so is Hong Kong is very capitalist, right? There's no welfare state to think of, no unemployment benefits. So I said, and at that time Hong Kong was running a big budget surplus. I said, so you got all this money, are you going to run a budget surplus? And he nearly fell. Oh, you're going to start unemployment benefits? And he nearly fell off his chair. And he looked at me and he said, look, we will pave the whole of Victoria Harbor and the whole of the Peak and build another 3 bridges across the harbor before we do unemployment benefits. Because unemployment benefits, once you give them, you can never take them back. We know that when we say we're going to build a bridge and it's going to cost $1 billion, we actually know it's going to cost $3 billion, but we don't care because it ends in time. And then he said, and they feel exactly the same way across the border. And sure enough, that's exactly how China responded to 2008, right? They went all out on an infrastructure spending plan. So you did have a big increase in debt, but my point is, with that big increase in debt, you actually see where the money went in China. You do see it. They've built high-speed rails, they've built roads, they've built ports, they've built airports. Now, we can debate the productivity of all these infrastructure spending. But however unproductive a highway might be, it's going to be more productive than grandma's hip replacement, which is what the Western world broadly funded. So again, I think when we compare debt, yeah, we can compare debt, but are we really talking about the same thing? I'm not 100% sure that we are. Now, I'd like to say one more point. And here I think this goes to really the crux of this currency debate. One of our big sayings at GAFCAL is that economic activity is energy transformed. And most countries save US dollars, whether you're India, Indonesia, China, to buy energy, and mostly to buy oil. Let's call it what it is. Like, most people hold dollars to buy oil. It used to be that you save dollars to buy Caterpillar machines and to buy Ford trucks, but that's no longer the case. Today, you want to buy a Ford truck. Actually, nobody does. You want to buy a Caterpillar. Actually, you'll buy Longhorn machinery. It's cheaper. It's just as good, and it's probably better by now. So for a lot of the industrial goods, you actually no longer need dollars, but you still need it for energy. You still need it for all the commodities. And here I think that we get to the single most important macro development of the past 15 years that everybody forgets, is that thanks to the shale revolution, the U.S. became an energy superpower. The U.S. basically added a Saudi Arabia in the space of 15 years. For me, that was really what's underpinned dollar strength. That's what's underpinned the U.S. bull market. The fact that for 15 years, the U.S. had a much cheaper cost of energy and more plentiful energy than anybody else. From there, from that realization, the question is, what happens over the next 10 or 15? Do we think that the U.S. will remain at the center of the next energy revolution? If it does, then fine, the dollar stays king. If the U.S. remains the center of where the marginal increase in energy production in the world happens, the U.S. remains the king. If the U.S. continues to have the cheapest cost of energy, etc. Now, what I do know is that China is starting to grow by leaps and bounds in nuclear. It's starting to get really a huge comparative advantage. It's probably now, beating everybody in terms of the molten salt reactors, which I think are the energy of the future. China is also the leading provider in solar. And this by a long shot. I don't think anybody can catch up at this point. If you're a big believer in wind, which I'm not, but if you are, then Germany and Scandinavia are the big winners there. So if you think solar is a winner, wind is the winner, again, I do not, but if you do, then Europe actually has a shot. If you think that in 10 years' time, we're still, piggybacking on the growth of U.S. energy production, mostly in oil and natural gas, and that this is where the marginal increase in energy in the world will come from, then the U.S. stays king. That's not my belief, and that's not my belief because the U.S. has stopped investing in that field for the past 7 or 8 years.
Louis, I think energy is a great point because we're quoting Alexei Miller, the CEO of Gazprom, where he said the game of nominal value of money is over, as this system does not allow to control the supply of resources. Our product, our rules. We don't play by the rules we didn't create. And over the course of the research for the In Gold We Trust report, we were explaining this gold drain that the United States experienced. The US had like roughly 30,000 tons of gold, and then all those surplus countries like Germany and France actually, they were building up their gold reserves, and this gold drain really became bigger and bigger, and then obviously 15th of August 1971, they stopped that and temporarily, of course, ended the peg of the US dollar to gold. And what was interesting was it reminded me of something that Peter Miller once told me, and therefore I went to the OPEC library in Vienna, and actually I found that document because I thought it was really interesting. Because what most people think that the inflation and the surge in oil prices in the 1970s was mainly due to the fact that we've seen those two wars, but actually OPEC came out on October 7th, 1971, and they basically said, due to the new situation in the United States, noting that these developments have resulted in a de facto devaluation of the United States dollar, the currency in which posted prices are established vis-a-vis the currencies of the major industrialized countries. So they said, the member countries of the OPEC shall take necessary action and or shall establish negotiations individually or in groups with the oil companies with a view to adopting ways and the means to offset any adverse effect on the per barrel real income of member countries resulting from the international monetary developments as of 15th of August 1971. I thought that was really fascinating because you don't read that too often. So the question would be, do you think that you mentioned the shale revolution, which is obviously important, and that also is telling me that Europe is the big loser again, because obviously on the energy side or on the resources side, we're much weaker than emerging markets and obviously the United States. But do you think at some point with the BRICS or however you want to call that organization, the Shanghai Cooperation Organization, that at some point they will say, well, actually, we're playing by the new rules now, and we just don't want to sell it in dollar terms anymore. We'll go for whatever currency, and we've already seen that starting, but so far it hasn't really become a big topic, it seems. So what's your view on that?
Me or Louis?
Yeah.
Do you want to take it first,
Brent.
Louis, or do you want
I'll take it. Look, go ahead. Sorry.
Go ahead. I'll follow you.
No. I was going to say, look, we've moved from 0 to 20% of oil being priced in other currencies. I mean, Russia's, a major, one of the top 3 producers in the world. It's obviously gone ex-US dollars now. The big question is whether the Middle East would follow suit. And to be honest, I think that's unlikely in the near term, at least. So, like, looking at the next few years, mostly because all these regimes still depend on U.S. protection. Sorry, with the exception of Iran, of course. Iran has now also moved full, non-U.S. dollar. It's selling pretty much all of its oil to China, and it's selling it for renminbi. So, I think China's first goal was, how do I get all my imported oil in my own currency rather than U.S. dollars? And they're not 100% there yet, but they're like 2/3 of the way there yet now, between Iran and Russia, both taking 100% RMB for both oil and natural gas. They've also signed natural gas contracts with Qatar for renminbi. So they're about 2/3 of the way on natural gas as well. So again, like they're not at their 100% goal, but for them it's already an important change, because by the time you move to paying for your currency, for your oil in your own currency, then you've lost the biggest constraint on your growth, right? It's like, you can always print your currency, you can always get more of it, and you can't suffer from international sanctions. So again, China's not 100% there. They're about 2/3 of the way. I think it's too much of a hurdle to convince Saudi Arabia, and I think China realizes that. So the way they're doing is, instead of saying, how do we get to 100%, is how do we make sure that the 2/3 we can get are sufficient for us? And that's why they're plowing money into nuclear. That's why they're plowing money into solar. That's why they've plowed money into electric vehicles. It's how do we make sure that the 2/3 we have is basically what we need. So I think there's a better odds of that happening, of them being able to get down to the 2/3 that they need through nuclear, through solar, and through more investments into pipelines into Russia and into Kazakhstan than they are into convincing Saudi Arabia.
So my take on this is a couple of things. You referenced the oil for dollars deal back in, I think that was in 73, but it happened after the embargo in 71, right? Or 72. I'm getting these numbers mixed up.
The embargo was 73.
Yeah. Sorry.
Kippur,
okay.
The Kippur was 73.
Right. Okay. So what I think many people overlook is, not only did that event start the oil for dollars, regime, for lack of a better way of saying it, it also started the revolution in the Eurodollar market. That is when the Eurodollar market went exponential. Now that's 50 years ago now, or 40 years ago now. And the Eurodollar market has grown absolutely incredibly large during that time. And that happened during a time where dollars were plentiful. And the reason dollars were plentiful was because the United States was buying their oil from overseas. And the way they bought their oil overseas is they sent their dollars overseas. And so that pushed dollars out into the world, and they circulated out in the world. Now we fast forward to 10 or 15 years ago, 20 years ago, when the shale revolution started. And to the point made earlier, we're now the biggest energy producer in the world. That means two things. One is it's not really self-sufficient because we import a lot, we export a lot, but we're the biggest energy producer in the world. We're not buying nearly as much from overseas as we used to. That matters because we're now not sending our dollars overseas the way we used to. But all of that debt, all of that Eurodollar credit, $30 trillion worth, 80 trillion in derivatives, swaps. That is a hell of a lot of dollars. And the fact that dollars are not getting exported to the same extent anymore makes it difficult for those to be serviced and to pay it off. Now, the reason that is still important is because now we're getting into this area or this time in the world where we're no longer cooperating, right? Not only are we not exporting our dollars to the extent we used to be, but now we're also getting divorced, which means further division, right? And so it does become critical for these other countries. How do they get oil that is still priced in dollars? And so far, this has been a very friendly discussion, and I want to keep it a very friendly discussion. But I do. 2 times today, Louis has quoted this 20% of oil trade priced not in dollars. I know that there was a headline that said that. I know there was an analyst, and it was in the Wall Street Journal that said that. I do not think that that is an accurate number. I cannot get to that number. If anybody on this panel can show me how that number is calculated, I would love it. Because I think what they did is they took trade that didn't take place in the US dollar, or it was invoiced in a currency other than the dollar and included it. And then they took a currency that was pegged to the US dollar but wasn't the US dollar and used that. And my point is that even if 20% of the world's energy is no longer priced in the dollar, it's still a big problem because the US is not exporting dollars the way it used to. But I don't believe that that number, that 20% number, is accurate. So I'm happy to be proven wrong because I can't figure out how they get to that number.
Oh, it's pretty simple. You kick Russia out, and China had already done a bunch of renminbi deals with Kazakhstan, with Qatar.
But they're invoiced in RMB. They're not priced in RMB. That's a big difference. They're still priced in US dollar equivalent.
Yeah, but they're settled in renminbi. That's all China cares about. China's sending renminbi over. And then you throw in the fact that Russia is, you take Russia, pick any commodity you care to think of, it's either number one or two, sometimes third exporter in the world. So that 20%, like kicking out Russia has had consequences, and that's it. You move from 5% of the market not being priced in dollars to 20. Now, I will take one exception. When you say the U.S. is not exporting dollars, in 2023, the U.S. current account deficit was a record $880 billion. So that's $880 billion that the U.S. is sending every year to the rest of the world to service existing debt, to buy the commodities we need. So the U.S. is exporting dollars. It's exporting them by the bucket load. It's never exported that many dollars.
That is true, but not for oil. And if we're talking about oil and energy prices rise, which I think we both agree.
I think we both agree. But I think to me that's dumbfounding. Is that the last time the U.S. current account deficit broke below $500 billion it was in 2006, 2007, 2008 when the oil price was shooting up. And back then, roughly half of the deficit was energy. Since then, the U.S. has had a massive shale boom. It's basically cut out its entire energy deficit, give or take, just rounding errors. And the U.S. current account deficit has grown from there. So with the U.S. becoming energy self-sufficient, we should have expected the U.S. current account deficit to improve. And it did. It did. From 2012 to 2017, the U.S. current account deficit improved. It was getting smaller every year. So the U.S. was exporting fewer and fewer dollars. And since 2017, and especially since 2020 and all the crazy fiscal deficits, etc., the U.S. current account deficit has just exploded to the point where the U.S. is now running twin deficits of year in, year out of well above 10% of GDP. Now, usually when a country moves to twin deficits over 5% of GDP, the IMF starts booking their first class airplane tickets. Now, of course, the U.S. being the U.S., it can withstand 10% for a long time. But let's not kid ourselves that the U.S. is not exporting dollars. It's exporting them like crazy. And for now, I think it hasn't been an issue for the dollar because the U.S. equity markets were pretty much the only game in town. And the U.S. equity markets were the only game in town because of 7 stocks. So that money kept being recycled constantly into U.S. assets. Going back to this idea of store of value, the U.S. equity market has been a tremendous store of value. But if it stops being so for whatever reason, if the U.S. stock markets start going down, then you could easily have, just as on the way up, the U.S. stock market was sucking in dollar. On the way down, it could spew out even more dollars into the rest of the system.
Well, so let me just follow up here. So, as of right now, you are correct, but I think we're talking about a world in which this divorce is taking place. And China is decoupling from the U.S. and the U.S. is decoupling from China. And we've got West versus East. And we don't have the same trade dynamics that we have today. And my point is that if we get, this is my belief, is if we get into that type of scenario that we're discussing, this divorce. And under that scenario, China is no longer selling as much into the United States market that can still afford to pay at current prices. And they now have to sell into other emerging markets, frontier markets, developing markets at lower prices. I don't think that will allow their yuan to stay as strong, because to your point earlier, their debt is a little different than ours. So if, the father owes the son, they don't owe it internally, they don't owe it externally, they can just take care of it internally. Well, yes, but the way they take care of it internally is let the currency lose value, right? So you cannot have a situation where China writes off all this internal debt or doesn't have to pay on this internal debt and keeps a strong yuan and keeps selling to emerging markets at the same prices that they are selling to the U.S. And so I think when we get into these events in the years ahead, I do not expect them to go smooth. I expect them to be very volatile. And I think that will make the dollar even stronger. And I think that it may hasten the split out of necessity. But I don't think it will be one where China, Russia, the rest of the world, the side on the other side of the West, however you want to define that, either is a clear winner or is able to do so in a non-economically violent fashion.
And I think this is where our big difference lies. I think you've put your finger on it. I think most Westerners have a view that if China can't export as much to the U.S., it's stuffed, and that it's screwed. The reality is, I just said earlier, China's the biggest car exporter in the world. How many of these cars are you seeing on U.S. streets? The answer is zero. These cars are being sold to Indonesia, to Saudi Arabia, to Chile. The trains that China's selling, the turbines, the solar panels, the nuclear power plants, the thermal power plants, all these things, they're not being sold in the U.S. And they're being sold increasingly across emerging markets. And like I said earlier, all the growth in the world in trade is happening emerging market to emerging market. And it's really China to emerging markets and emerging markets back to China. That's where the growth of the trade is. And so China's dependency on the U.S. actually goes down every single year. 10 years ago, China was massively dependent on the U.S. It really just isn't the case anymore. And here, perhaps ByteDance, TikTok is a perfect example where the U.S. says, you know what, you're gonna have to sell a TikTok, and they say, you know what, it's 17% of our business. We'd rather shut it down than give you that satisfaction. We'll just shut it down. It's 17% of our business. We don't really care. And in fact, you'll have to deal with the consequences of it in the U.S. because you're going to piss off young people. You're going to have 7,000 people fired in the U.S. And, so be it. And so I think the view that, if China doesn't have the U.S., it's stuffed, it's a very U.S.-centric view that was a reality 10 years ago and no longer corresponds to the reality of China's trade flows today.
Well, I'll just say one last thing, and then we can let this go. Part of the reason they are able to sell to these other emerging markets is those other emerging markets are selling into the United States. And the economies in the United States has been very good the last 3 years. Should that change? Are you saying that Mexicans, that U.S. isn't going to buy things from Mexico because Mexicans are buying Chinese cars? That seems unlikely to me. If the U.S. does that, they're like completely cutting their. Well, if you are of the belief that this divorce does not continue to accelerate and instead starts to cooperate more, then I think you're absolutely right. But if, like me, you think this divorce accelerates and more trade barriers go up, not less, and sides get chosen more than they've already chosen, I do not believe that China will continue to be able to sell. They'll be able to sell all of their production, but at a much lower price than they're currently selling into the markets that are dependent upon the United States. I do not believe the U.S. can have a recession and the rest of the world doesn't feel it. So, but I think maybe that's where we disagree. I think maybe you think.
I'm not saying the U.S. is having a recession. No. My point is, China's markets are no longer primarily the U.S.
Right, but the markets that they sell into, those markets are the U.S. All those countries that you mentioned, they sell into the U.S. The whole world's connected. You can't just say they don't use the U.S.
But I don't
anymore,
think
right?
I don't think the U.S. can turn to Indonesia and tell Indonesia, look, if you buy Chinese cars, then we won't buy your nickel. Like, if the U.S. does that, yes, you're right, it's a completely different world. But I don't think the U.S. can credibly do this. I don't think the U.S. can turn to Saudi Arabia and say, hey, if you keep buying Chinese cars, if you keep buying Chinese earth-moving equipment, we're going to make sure that the oil you try to sell around the world isn't going to flow. If the U.S. does that, it's going to piss off absolutely everyone and end up, cutting the very branch on which it sits on. That doesn't seem credible to me.
That's the economic volatility that I'm talking about.
One question that combines maybe the euro and Bitcoin. Basically, this story is this: Europe has been trying to de-dollarize in a way by coming up with the euro. This is going back decades, right? And shortly before the war in Ukraine started, shortly before Russia attacked Ukraine, there was a huge gas deal priced in euros that and also using euro that China and Russia came up with. They since have switched to rubles and yuan and have dropped the euro. The euro has been completely dropped by many after the ECB also cut off Russian reserves. Do you guys think that there was a chance there for Europe to not go along with the sanctions and position itself as in between and position the euro as something as an alternative to the dollar in international trade, or is this a political thing where they just had to side with the West? And the second question, of course, is technically a lot of this stuff could be done with Bitcoin. I know Putin has talked about it once. There hasn't been a lot of developments, but I do have to ask your opinion on the next 10 years. Is there any chance that you see that that the world will move to a neutral reserve currency or a neutral trade currency like that?
Well, so I'll take this first. People don't like it when I say this, but Europe has always been a vassal state from the United States for the last 80 years. And when push comes to shove, that's the truth. And I know that's not the nice, friendly, peaceful thing to say, but that's the truth. And that is what has played out. So I don't think that I don't think Europe, without having an incredible geopolitical crisis, would have been able to side with China or Euro or Russia and use euros. And as a result, they didn't. One thing I want to point out, because you just mentioned something, I think it's important that people realize this, is when people say Russia no longer sells energy in dollars and euros, they only sell it in rubles. Well, here's the thing. Nobody outside of Russia has rubles. So the only way to get rubles is to buy them from Russia. So how do you do that? Well, you wire euros and dollars to Gazprom Bank. Gazprom Bank takes the dollars and euros and gives you rubles. And then you go buy rubles with energy. Or you go buy energy with rubles. But all they've really done is put a step in between. So the idea that Russia no longer sells energy in anything other than rubles or yuan, it's a shell game. So Russia is still getting dollars and euros for their energy. But, as far as, kind of a peaceful solution to all this, I would love to say yes. I would stand on the top of the Empire State Building and yell I was wrong if we can get out of this with some kind of a peaceful solution. But I just feel like the dice have been rolled, and we just kind of, the leadership of all these countries, they want to stay in power. And I don't think any of them are going to back down. I think they're all psychopaths. And I don't think that you can look at them as regular, normal, thoughtful, logical people. I think they're going to do what they think that they need to do to stay in power. And unfortunately, I think that's going to cause a lot more chaos and a lot more volatility.
Just wanted to say that's the major advantage
Sorry about that, guys.
of Xi Jinping, because he doesn't have to care about being re-elected. Yeah, Louis.
That's true. That's true.
Yeah, look, I actually had a presentation 6 months before the Ukraine war broke out, saying, look, as this is Europe's big moment. All of a sudden, Europe's going to get energy priced in euros, and this is, this was the case to be bullish Europe. That all of a sudden we would be getting a cheap cost of energy. The big case for being bullish the U.S. for the past 12 years was that the U.S. had a much cheaper cost of energy. And the U.S.'s cost of energy is always in dollars, of course. And then all of a sudden, Europe had that window where it looked like, we were going to get a ton of cheap Russian natural gas priced in our own currency. And then from there, of course, Russia owns all these euros, so they would be buying European cars, buying houses in Europe, or, European goods. So it would be a very, positive self-reinforcing virtuous circle. And of course, the war's thrown out in the water. Now, we could debate all day. Could Europe have handled it better? Could Europe have done this? Could Europe have done that? It doesn't really matter, right? Here we are. Europe had a chance. That chance is gone. And so be it. And Europe's loss, for me, isn't so much the emerging market gain as it is. It's not as much Russia's gain as it is the emerging, or the U.S.'s gain as it is the emerging markets gain. And I think this is very important. I don't think there's energy is trading in rubles, but energy is definitely trading in renminbi, and it has traded in Indian rupees, because what Russia has done is it has gone to countries like India and said, hey, how about I sell you energy in rupees at a 30% discount to the market price, which of course is a huge game changer for a country like India, and it's a huge game changer for a country like China. Now, the problem for Russia is they've earned rupees, and what do we do with these rupees? Now, the renminbis, they know what they can do with. They can buy cars, they can buy smartphones, they can buy computers, they can buy all sorts of things that they need. India's less obvious. Which brings me to your point, Niko. Could we move to a world in which some of this trade is settled in Bitcoin? And here you get to the obvious question is, more than 2 years into this horrible war, why hasn't this happened yet? Inherently, 2 years ago, if you'd asked me the question, I would say, yeah, that makes a ton of sense, right? That should be totally happening. This trade should all be moving into Bitcoin. And to be honest, we saw as soon as the war started, all the Russians started buying Bitcoin like crazy. All the rich Russian were like, oh my God, all my money is going to be frozen. Quick, move it onto a USB key, and off I go. But 2 years later, you do have to wonder, why isn't this happening? Now you could say perhaps because the guys on the other side, perhaps China's like, no, I'm not paying you in Bitcoin. I'm paying you in renminbi. Perhaps because India the same. They feel, okay, we've got these guys over a barrel. Might as well, no pun intended. We've got these guys over a barrel. Let's, if we can buy in local currency, that's what we want to do. Bottom line is it hasn't happened. And today what you're seeing is a massive transfer of wealth from Russia. Russia for 200 years was organized to extract commodities and sell them cheaply to Europe. And now all of a sudden it's extracting commodities and selling them at a discount to India, to Indonesia, to Korea, to China. So this is a huge benefit for those guys. And that's one of the drivers of the underlying boom that you're seeing in these countries. A boom that most people are missing. For all the talk about how the U.S. is the only place to invest, etc. Few people realize this, but so far this decade, so in the 2020s, Turkey's actually done better than the U.S. Turkish stock market in U.S. dollar terms, because obviously the local currency is devalued a lot, but Mexico's outperformed the U.S. India's outperformed the U.S. You look at emerging market debt markets. Indonesia, China, India, Brazil, Mexico, all these countries have outperformed the U.S. debt markets, not by a little, but by 40, 50, 100%. Like the outperformance of these markets has been absolutely enormous. We're living through a completely new emerging market cycle where you're seeing the Fed tighten. You're seeing an emerging market crisis, Russia invading Europe. You're seeing China be overall pretty weak. And against that, massive outperformance of emerging market debt market and even some of the equity markets. And nobody cares, which is great because it means that this bull market has long to go.
It's always funny to me that this is one of the things that I find fascinating about markets is that different people can look at the exact same information and come to wildly different conclusions.
And that's what markets are all about, isn't it? Wouldn't it be boring if we all had the completely same opinion? But gentlemen, I think that has been a great conversation. I really enjoyed it. Many thanks to Brent and Louis. Many thanks, Niko, for taking the time. I think we discussed a really wide range of topics. I think we all agree that Europe is screwed, and that actually de-dollarization is a long process.
Which probably means
one moment in time,
but maybe probably means you want to go long.
Maybe that's the contrarian play. Maybe, I was going to say maybe we should buy Europe.
So yeah, I think we talked about gold. We're all pretty excited about gold. From our point of view, that the Western financial investor isn't the marginal buyer anymore. I think this has really changed over the last couple of quarters, which is going to be a core topic of this year's report. But anyways, I really want to thank you from the bottom of my heart. I very much enjoyed that. I learned a lot. Would be more than glad to host you for drinks in Vienna, Louis and Brent. Niko, of course, we'll have an interview after the In Gold We Trust report very soon. So, yes. Gentlemen, again, thank you very, very much.
Thank you very much.
Great to see you.
Thanks for having me.
Good to catch up.